In 2010, a single country with an economy smaller than the state of Texas nearly destroyed the entire European financial system. Greece, representing just 2% of the European Union's GDP, triggered a crisis that threatened €1.2 trillion in sovereign debt across the eurozone and exposed the fatal flaw in history's most ambitious monetary experiment. I'm not a doomsday preacher, I'm just looking at the data. And the data from 2010 to 2015 reveals something terrifying. In an interconnected financial system, the debt of one small nation can become a contagion that spreads across continents, crashes banks in Germany and France, and forces ordinary citizens in Spain and Portugal to pay for mistakes they never made. Today, we're dissecting the European debt crisis, not just what happened, but how the domino effect works, and why understanding this crisis is critical for recognizing similar patterns forming right now in global markets. Why did this crisis explode in 2010 specifically? The answer lies in the perfect storm that had been brewing since the euro's creation in 1999. When the European Central Bank launched the euro, it created a currency union without a fiscal union. Think about that. 17 countries sharing one currency but maintaining separate budgets, separate tax systems, and separate debt obligations. It's like 17 roommates sharing a credit card but each one spending independently, with no one checking the bills until they're overdue. The 2008 financial crisis exposed this fundamental flaw. As global credit markets froze, Greece's government revealed in late 2009 that its budget deficit wasn't 6% of GDP as previously reported, it was actually 12.7%. Goldman Sachs had helped Greece use derivatives to hide billions in debt, keeping it off the official books. When this truth emerged in early 2010, investors realized, if Greece lied, who else is lying? Bond yields started spiking. By April 2010, Greece's 10-year bonds hit 8.5%, triple what Germany paid. The crisis had begun. Let's start with the core issue that made this crisis inevitable. Greece, Spain, Portugal, Ireland, and Italy were locked into a currency they couldn't control. In normal times, when a country has too much debt and loses competitiveness, it devalues its currency. This makes exports cheaper, tourism more attractive, and gradually restores economic balance. Argentina did this in 2001, Russia in 1998, even the United States effectively did this by leaving the gold standard in 1971. But eurozone countries surrendered this tool when they adopted the euro. Greece couldn't devalue the drachma because the drachma no longer existed. Spain couldn't weaken the peseta. Portugal couldn't adjust the escudo. Here are the brutal numbers. From 2001 to 2008, Greece's government debt grew from €150 billion to €263 billion, a 75% increase. Spain's debt jumped from €320 billion to €440 billion. Portugal went from €65 billion to €123 billion. These countries were spending far beyond their means, financing it with cheap borrowed money, and the euro's credibility allowed them to borrow at German-like interest rates, around 4% to 5%, even though their economies were fundamentally weaker. Why were they borrowing so much? In Greece, government jobs increased by 25% from 2000 to 2009. Public sector wages rose 40% faster than private sector wages. The pension system paid out benefits equal to 17.5% of GDP, one of the highest rates in the world. People were retiring at 53 with full pensions. The government railway company had 6,500 employees but only transported 600,000 passengers per year, that's €250,000 in costs per passenger. Spain's situation was different but equally dangerous. Spanish banks had created a massive real estate bubble. From 2000 to 2007, housing prices doubled. Spanish banks issued €323 billion in new mortgages in 2006 alone. When the global financial crisis hit in 2008, Spanish property values collapsed by 30% to 40%, leaving banks with mountains of bad loans. Portugal had a competitiveness problem. Its productivity hadn't grown in a decade, wages were rising faster than output, and exports were losing market share to China and Eastern Europe. By 2010, Portugal's current account deficit reached 10% of GDP, meaning the country was importing far more than it exported, financed entirely by foreign borrowing. When the crisis hit and bond markets panicked, these countries faced impossible math. Their debts were denominated in euros, they couldn't print euros, their economies were shrinking, tax revenues were falling, and interest rates were exploding. Greece's 10-year bond yields hit 30% by 2012. Portugal's reached 17%. Spain's touched 7.6%, the danger level where debt becomes unsustainable. Now here's where it gets darker, the hidden manipulation that masked the true scale of the problem until it was too late. Greek debt wasn't just high, it was deliberately concealed using derivatives called currency swaps. Between 2000 and 2009, Goldman Sachs structured deals that allowed Greece to borrow billions without reporting it as debt. Here's how it worked. Greece would sell future revenues like airport fees and lottery proceeds to Goldman Sachs in exchange for upfront cash. On paper, this looked like a revenue transaction, not borrowing. But in reality, Greece had to pay back this money with interest. It was debt disguised as asset sales. One specific transaction in 2001 allowed Greece to hide €2.8 billion in military spending debt. Another deal in 2002 hid €5.3 billion by using off-market exchange rates in currency swaps. By 2009, Goldman Sachs had earned over €600 million in fees from these arrangements, and Greek debt was actually €300 billion, not the €230 billion officially reported. But Greece wasn't alone in financial engineering. Irish banks had created something called Anglo-Irish Bank, which became the poster child for corrupt lending practices. Between 2003 and 2008, Anglo-Irish Bank's assets grew from €50 billion to €101 billion. Much of this was lent to property developers with connections to bank executives. In one notorious case, the bank lent €305 million to one developer to buy shares in the bank itself, propping up its stock price artificially. When investigators looked closer, they found bank chairman Sean Fitzpatrick had hidden €87 million in personal loans from shareholders through circular accounting tricks. Spanish banks had their own manipulation. They were using something called floor clauses in mortgages, hidden terms that kept customers paying high rates even when the ECB cut interest rates. But more critically, Spanish banks weren't marking their real estate loans to market value. Bankia, Spain's fourth-largest bank, reported a €300 million profit in 2011. When forced to restate its financials in 2012, it actually had a €3 billion loss. The bank had €37 billion in bad real estate loans, one-third of its loan book, but had been hiding this through accounting gimmicks. Portuguese banks had a different problem: exposure to Brazilian debt. Banco Espírito Santo, Portugal's largest private bank, had created a web of holding companies that owned each other in circular patterns. The bank's exposure to the parent company's debt was hidden through offshore entities in Luxembourg and Switzerland. When this unraveled in 2014, investigators found €4 billion in hidden losses. The scariest part? European banking regulators knew about many of these practices but didn't act. The European Banking Authority conducted stress tests in 2010 that gave Irish banks passing grades just months before they collapsed. Spanish banks passed stress tests while hiding real estate losses. Why? Because revealing the truth would trigger panic. Here's what made this crisis systemic: European banks were massively interconnected through sovereign bonds and interbank lending. German banks held €19 billion in Greek government bonds, €140 billion in Spanish bonds, and €45 billion in Irish bonds. French banks held 27 billion euros in Greek bonds, 85 billion euros in Spanish bonds, and 21 billion euros in Italian bonds. When Greece's bonds lost 50% of their value in the 2012 restructuring, French banks lost 13.5 billion euros in a single day. But the real danger was in the derivatives market. European banks had written 2.8 trillion euros in credit default swaps, insurance contracts on sovereign debt. If Greece defaulted, these contracts would trigger immediate payment obligations across the banking system. AIG's collapse in 2008 had shown what happens when one institution can't pay its CDS obligations, the entire system freezes. The interbank lending market seized up. In 2010, Spanish banks stopped lending to Italian banks. French banks refused to lend to Greek banks. German banks hoarded cash instead of lending to anyone in the periphery. The overnight lending rate between banks, normally just 0.3% to 0.5%, spiked to 1.8% in November 2011. Banks were so mistrustful of each other that they preferred parking money at the ECB for 0.25% rather than lending it to other banks at higher rates. This created a death spiral. Countries with debt problems couldn't roll over maturing bonds because investors demanded higher rates. Higher rates made debt more expensive, which increased deficits, which made investors demand even higher rates. Greece's debt-to-GDP ratio went from 130% in 2009 to 175% by 2012, not because Greece borrowed more, but because its economy shrank 25% and interest costs exploded. The contagion spread through economic linkages. When Greece imposed austerity in 2010, cutting government spending by 15%, Greek imports collapsed. This hurt Germany's export sector. When Spain's economy contracted, Portuguese exports to Spain fell. When Italy raised taxes, Italian consumers stopped buying French luxury goods. The entire eurozone GDP contracted by 0.9% in 2012 and another 0.3% in 2013, a double-dip recession. Then came the political contagion. In 2011, populist parties started winning elections across Europe. In Greece, the far-left Syriza party campaigned on defaulting and leaving the euro. In Spain, the Podemos party advocated nationalizing banks. In Italy, the Five-Star Movement wanted a referendum on euro membership. Bond yields spiked every time these parties gained in polls because investors feared euro breakup. How could an ordinary person identify which banks and institutions were most at risk during this crisis? There were specific warning signs that screamed danger if you knew where to look. First, bond yield spreads. When the spread between a country's 10-year bonds and German bonds exceeded 400 basis points, or 4%, that country was in crisis territory. Greece hit 2,600 basis points. Portugal reached 1,200 basis points. Even France briefly hit 200 basis points in 2011. You could track these daily on Bloomberg or the ECB website. Second, bank stock prices relative to book value. When banks trade below book value, meaning the stock price is less than the company's stated net worth, it means investors believe the assets are overvalued or hidden losses exist. In 2011, every major Spanish bank traded at 0.4 to 0.7 times book value. Italian banks fell to 0.3 times book value. This was a clear signal that markets didn't trust the reported numbers. Third, deposit flight. Greek banks lost 70 billion euros in deposits from 2010 to 2012, nearly 30% of total deposits. Spanish banks lost 200 billion euros. You could see this in monthly banking statistics. When deposits fall while bonds yields rise, it means locals are moving money out, the ultimate insider warning. Fourth, the ECB's emergency lending facility numbers. Every week, the ECB publishes how much emergency liquidity it's providing to national banking systems through something called Emergency Liquidity Assistance, or ELA. In 2012, Greek banks were borrowing €130 billion through ELA, more than Greece's entire GDP. Irish banks borrowed €85 billion. This was essentially the ECB keeping dead banks alive through life support. Fifth, credit default swap prices. While most retail investors couldn't trade these instruments, CDS prices were public information. When 5-year CDS on a country's debt exceeded 1,000 basis points, meaning it cost $10 million per year to insure $100 million in bonds, that country was in severe distress. Greece's CDS hit 5,000 basis points, meaning markets priced in an 80% chance of default. So how should someone protect themselves if they saw this crisis developing, or see similar patterns emerging today? Here are 8 concrete strategies ranked by priority. Priority 1. Move deposits out of affected banks immediately. If your bank is in a country with bond yields above 7% or trading below 0.5 times book value, move deposits to banks in core countries like Germany or the Netherlands. In 2012, Greeks who kept money in local banks lost access to their funds for weeks due to capital controls. Those who moved money to German banks preserved full access. Priority 2. Hold physical cash in multiple currencies. During the crisis, there were legitimate fears that peripheral countries might exit the euro and redenominate bank deposits into new, weaker currencies. Greeks who held physical euro notes were protected; they could still use euros after a potential exit. Hold at least 3 to 6 months of living expenses in physical cash stored securely. Priority 3. Buy German bonds or U.S. Treasuries as safe havens. When the crisis intensified, capital flooded into German bonds, pushing yields negative even though investors were paying Germany to hold their money. German 10-year yields fell from 3.5% in 2008 to 1.5% in 2012 and eventually to negative 0.2%. This provided capital appreciation as bond prices rose while yields fell. Priority 4. Short peripheral country banks through put options. For sophisticated investors, buying put options on Spanish and Italian bank stocks was enormously profitable. Banco Santander stock fell from €12 in 2010 to €4 in 2012. Intesa Sanpaolo dropped from €3.50 to 90 cents. Put options provided leveraged exposure to this decline with limited downside; you could only lose your premium. Priority 5. Hold gold as a euro collapse hedge. Gold rose from €900 per ounce in 2010 to €1,350 in 2012, a 50% gain, as investors feared currency instability. Gold provided protection against both currency devaluation and broader financial system breakdown. Physical gold stored outside the banking system was key, not paper gold or ETFs that could be frozen or restricted. Priority 6. Diversify geographically, but avoid all peripheral bonds. Many investors thought they were diversifying by holding bonds from multiple European countries. That was false diversification. Correlation approached 1.0 during the crisis, meaning all peripheral bonds fell together. True diversification meant holding assets in different continents: U.S. stocks, Asian bonds, Swiss real estate, Scandinavian stocks. Priority 7. Buy undervalued export-focused German companies. During the crisis, even strong German exporters saw their stocks fall 20% to 30% due to euro contagion fears, despite having solid balance sheets and global revenue streams. Companies like Siemens, BASF, and Daimler traded at 10 to 12 times earnings in 2012, cheap valuations for world-class firms with limited exposure to peripheral Europe. Priority 8. Avoid all bonds from banks and insurance companies. Bank bonds, called at-one bonds or contingent convertibles, could be wiped out if a bank needed bailout. Spanish bank bonds lost 60% to 80% of value during the crisis. Insurance company bonds were equally dangerous because insurers held massive portfolios of sovereign bonds that were declining in value. One more critical point: have a plan for capital controls. If you lived in a peripheral country, you needed to establish banking relationships outside your home country before controls were imposed. After controls began, it was too late. Greeks in 2015 could withdraw only €60 per day from ATMs and couldn't transfer money abroad at all. The crisis began with Greece's revelation of hidden deficits in November 2009. By April 2010, Greece couldn't borrow from markets and requested an EUMF bailout of €110 billion. Bond yields spiked across peripheral countries as investors realized the problem wasn't isolated. Ireland requested an €85 billion bailout in November 2010. Portugal requested €78 billion in April 2011. This phase was characterized by denial from European leaders. In May 2010, German Chancellor Angela Merkel said there was absolutely no question of Greece leaving the euro. European Central Bank President Jean-Claude Trichet claimed European banks were resilient. Meanwhile, the ECB secretly began buying Greek and Portuguese bonds through its securities markets program, purchasing €76 billion in peripheral bonds from 2010 to 2011 to suppress yields. They never publicly announced the amounts until years later. By 2011, the crisis spread to Spain and Italy, economies too large to bail out. Spain's economy is the fourth largest in the eurozone, Italy's the third largest. Combined, their government debt exceeded €2.5 trillion, more than the entire bailout fund capacity. In November 2011, bond vigilantes attacked Italy. Yields hit 7.26% on November 9, 2011. Italian Prime Minister Silvio Berlusconi resigned 4 days later, replaced by technocrat Mario Monti without an election. Spain's Prime Minister José Luis Zapatero was similarly replaced by Mariano Rajoy. This was the peak of contagion. Credit default swaps on Italian debt hit 550 basis points. French banks faced potential losses of €60 billion. The Stoxx Europe 600 Banks Index fell 35% from February to September 2011. The euro weakened from $1.48 in May 2011 to $1.27 by September. The crisis culminated in July 2012 when ECB President Mario Draghi said 3 words that changed everything: whatever it takes. Draghi promised the ECB would do whatever necessary to preserve the euro, including unlimited bond purchases. This verbal commitment, without even spending money immediately, crushed bond yields. Spanish 10-year yields fell from 7.5% in July 2012 to 5.8% by year-end. Italian yields dropped from 6.5% to 4.5%. The mere promise of ECB intervention stopped the panic. But this came at enormous cost. The ECB's balance sheet expanded from €1.5 trillion in 2010 to €3.1 trillion by 2015. The ECB implemented negative interest rates in 2014, charging banks 0.1% to park reserves. The institution created €2.6 trillion through quantitative easing programs from 2015 onward, buying government bonds and corporate bonds to suppress yields. The crisis ended politically in 2015 after Greece's third bailout of €86 billion. Total bailout commitments reached €630 billion across Greece with 3 programs: Ireland, Portugal, Spain, and Cyprus. Greece's debt was restructured, imposing a 50% loss on private bondholders, €107 billion in losses. The aftermath: unemployment in Spain peaked at 27% in 2013. Greek unemployment hit 28%. Youth unemployment in Spain reached 57%. Greece's economy contracted 25% from 2008 to 2015, a depression deeper than the 1930s in percentage terms. The social and political damage continues today with populist movements, mass emigration, and eroded trust in European institutions. Here's what you need to understand about the European debt crisis and domino effects in general. Interconnected financial systems amplify failures. When banks from Germany to Greece all hold each other's debt, when derivatives link every institution to every other institution, when currencies are shared but fiscal policies aren't, the failure of one small piece can cascade through the entire structure. The crisis revealed three timeless truths. First, governments will always lie about debt until they can't. Greece did it with Goldman Sachs, but every country has political incentives to hide problems. Second, financial contagion spreads faster than anyone expects, from Greece to Ireland to Portugal to Spain to Italy in less than 18 months. Third, central banks will ultimately choose inflation over deflation. The ECB printed 2.6 trillion euros rather than allow the eurozone to collapse. Now look at today's world. U.S. government debt is $33 trillion and growing. Chinese local government debt exceeds $9 trillion with hidden losses in property developers. Japanese debt is 264% of GDP. The patterns that created 2010 exist today on a larger scale. Am I saying we're about to see European debt crisis 2.0? Maybe I'm wrong. But here's the truth, the cost of being prepared is minimal, moving some money to safer banks, holding cash, diversifying geographically. The cost of being unprepared is catastrophic: frozen accounts, bank failures, currency redenomination, years of depression. You don't need to panic. You need to pay attention. Watch bond yields. Monitor bank stocks. Track central bank balance sheets. And remember, in interconnected systems, it's never just one bank, one country, or one crisis. It's always a chain reaction waiting for someone to pull the first domino. Stay informed. Stay diversified. And whatever you do, don't assume that because the last crisis ended, the next one won't happen.